2:2 Economic Analysis and Market Cycle. 2.2 Identifying leading and lagging sectors. Analyzing leading indicators can help identify sectors that tend to outperform during different stages of the economic cycle. Leading indicators are economic indicators that provide insights into future economic trends and can help predict changes in the business cycle. By monitoring these indicators, investors can gain an understanding of the potential direction and timing of economic changes, which can inform sector allocation decisions. Here are some leading indicators and their implications for sector performance. Purchasing Managers' Index, PMI. The PMI measures the economic health of the manufacturing sector. A PMI reading above 50 indicates expansion, while a reading below 50 suggests contraction. The PMI can provide insights into sector performance, such as expansion phase. During the expansion phase, a rising PMI suggests increasing manufacturing activity. Sectors related to manufacturing, such as industrials and materials, may outperform as demand for raw materials and industrial goods increases. Contraction/recession phase. A declining PMI indicates a slowdown in manufacturing activity. Defensive sectors, such as utilities and consumer staples, may be relatively more resilient during this phase. Housing market indicators. Indicators related to the housing market can provide insights into consumer spending, construction activity, and overall economic health. These indicators include housing starts. Increasing housing starts indicate growth in the construction sector, benefiting sectors such as materials, construction, and home improvement. Building permits. Rising building permits suggest future construction activity, which can benefit sectors like construction and building materials. Consumer confidence. Consumer confidence measures the sentiment and expectations of consumers regarding the overall economy. Higher consumer confidence can support sectors such as consumer discretionary, retail, and leisure hospitality as consumer spending tends to increase. Expansion phase. During the expansion phase, rising consumer confidence can signal increased consumer spending, benefiting sectors such as consumer discretionary and retail. Contraction/recession phase. Falling consumer confidence may lead to reduced consumer spending, making defensive sectors like consumer staples and healthcare relatively more attractive. Leading Economic Index (LEI). The LEI is a composite index that combines various leading indicators to provide a broad measure of economic trends. It can help predict turning points in the business cycle. A rising LEI suggests economic expansion, while a declining LEI indicates potential contraction. Sectors related to economic growth, such as consumer discretionary, industrials, and technology, may perform well during an expansion phase signaled by a rising LEI. Business investment. Investment indicators, such as business spending on equipment and capital expenditure, can provide insights into corporate confidence and future economic activity. Increasing business investment may benefit sectors such as technology, industrials, and materials. It's important to note that while leading indicators can provide valuable insights, they are not foolproof and can sometimes provide false signals. Economic conditions and sector performance can be influenced by a range of factors, including geopolitical events, monetary policy decisions, and unexpected shocks. Therefore, it's advisable to consider multiple indicators and conduct thorough analysis when making investment decisions. Moreover, sector rotation strategies should be evaluated in the context of an investor's risk tolerance, investment goals, and time horizon. Diversification across sectors and careful monitoring of leading indicators can help investors identify potential opportunities and adjust their sector allocations based on changing economic conditions. Consulting with a financial advisor or investment professional can also provide valuable guidance in this regard. Identifying lagging sectors that may underperform in specific economic conditions can be useful for investors to avoid or reduce exposure to sectors that are likely to face challenges or slower growth during certain economic conditions. While lagging sectors can vary based on the specific economic conditions and market dynamics, here are some examples. Interest rate sensitive sectors. Rising interest rates can negatively impact sectors that are sensitive to borrowing costs, such as real estate. Higher interest rates can increase mortgage rates, potentially reducing demand for housing and affecting real estate development and investment. Utilities. Utilities often carry high levels of debt and may face higher borrowing costs when interest rates rise, impacting their profitability and potential returns. Highly cyclical sectors. During economic contractions or recessions, highly cyclical sectors may face challenges as demand weakens and consumer spending declines. These sectors include consumer discretionary. Sectors such as retail, travel, and leisure can experience reduced consumer spending during economic downturns as people prioritize essential expenses and cut back on discretionary purchases. Industrial sectors, including manufacturing and construction, may face reduced demand and slower growth during economic downturns as business investment and infrastructure projects decline. Financial sector in economic turmoil. During periods of financial crisis or economic instability, the financial sector can face significant challenges. Banking and financial institutions. These sectors may be affected by credit market disruptions, reduced lending activity, and increased loan defaults during economic downturns or financial crises. Commodities and energy sectors. The performance of commodities and energy sectors can be influenced by factors such as commodity prices, supply-demand dynamics, and geopolitical events. Oil and gas. These sectors can be sensitive to fluctuations in oil and gas prices, which can be influenced by global supply, demand, and geopolitical factors. Mining and metals. The performance of mining and metal sectors can be impacted by changes in commodity prices and demand, which can be influenced by global economic conditions and trade dynamics. Old economy sectors. Certain traditional sectors may face challenges as technological advancements and changing consumer preferences impact their growth prospects. Traditional retail. Traditional brick-and-mortar retailers may struggle with increased competition from e-commerce and changing consumer shopping habits. Legacy media. Traditional media sectors, such as print publishing or broadcast television, may face challenges as digital media and streaming platforms gain popularity. It's important to note that the performance of sectors can also be influenced by company-specific factors, management quality, industry trends, and other factors beyond macroeconomic conditions. Additionally, timing sector rotation decisions based solely on economic conditions can be challenging, as markets can be unpredictable and sectors can exhibit varying degrees of sensitivity to economic changes. To make informed investment decisions, it is advisable to conduct thorough research, consider a combination of leading and lagging indicators, and diversify across sectors to manage risk. Consulting with a financial advisor or investment professional can provide valuable insights and guidance in identifying sectors that may underperform in specific economic conditions.